Check 1, 2. Looks good. Dion?
Check, check, check.
Yeah, looks good. Yep.
Changing.
Yeah.
And we are live. We're back in the building. We're back in the boiler room. We have in the building with us Jacob, mortgage agent at iBridge Capital.
Hello.
We have with us Uncle D, Dion,
Uncle D. Hi there.
iBridge Capital, and yours truly, Sammy Janation. So today we're going to go in and I think we're going to do our first shoot. We're going to be talking a lot about first-time home buyers. Some of the things that the first-time home buyers need to or would want to know when it's that special moment that they buy their first place. So we're going to kick it off. Sounds like a silly question, but what is a first-time home buyer? You want to start with that one?
Sure. First-time home buyer. I myself was a first-time home buyer years ago, where you're saving enough money for your first down payment, either 5, 10, or 15, or 20% down, and basically we talk about how do you get home ownership versus paying rent for someone else and paying off someone else's mortgage, right?
Yeah. And I think there's one exemption to that first-time home buyer rule. So the rule is that if you own a home for the very first time, you are eligible for the home buyer's plan benefits. There's another rule also that if you or your spouse or common law have not owned a home for the last 4 years, or if you've not been on title for any home in the last 4 years, you do qualify once again for the home buyer's plan privileges.
Okay.
So that's that.
That's good to know.
Jacob,
Hello.
my friend, you're transitioning from rent to home ownership.
Yeah. Oh, fingers crossed.
Fingers crossed.
Yeah.
I think we're going to do that hopefully within the next 6 months to a year. I'm going to
Yeah.
be ambitious and say that.
Sure. Absolutely.
Tell us a little bit. So, before you came into the industry, you probably had 101 different questions.
Yep.
And you probably learned 101 different things coming in.
Definitely.
What are some of the things that you would suggest to different people transitioning or in that same life stage that you're in?
Sure. I'd say surround yourself with good resources.
Okay.
Having a good mortgage broker and having a good realtor is very important, because a bad mortgage broker and a bad realtor won't point out the things to you that you need to know. Things that you don't know, they won't help educate you in the way that they should. So definitely having good resources, good people to bounce questions off of. And as well, knowing your budget is very important. Obviously, you can't just get into the market not knowing what you're looking for, putting in offers on different things that you're not necessarily qualified for.
It's sorry to cut you off. It's funny that you say that, right? We say the word bad realtor and bad mortgage agent.
Right.
I mean, we don't mean that they're bad people, but there's some that are less experienced or more experienced, or some that will value your time completely differently based on whether they think you're a prospect or you're actually going to go in and close
Right.
as a realtor or a mortgage agent, right? Let's talk a little bit about the home buying cycle, right? There's 4 main players when it comes to purchasing your first home as a transaction, right? You're going to have yourself as the borrower. You should have a great realtor who's helping you buy that home,
Yep.
whether it's a new build or not. And I think there's also a great mortgage agent who can help you and break down the different aspects of what truly is a mortgage and how it can make or break or make your life even more seamless. And the final thing is having a great lawyer, right? So having a great lawyer that sits there and understands, or that you can connect with and feel comfortable with enough to ask the proper questions, right? We sit there and we pay a bunch of money in fees and we don't know what it is, or we don't take advantage of the value that some of these lawyers or realtors or mortgage agents can provide you. So there's that.
Yeah, absolutely.
Well, they also pinpoints help differentiate what you're getting into, right?
Yeah.
Reading the fine lines, the fine prints, reviewing if you're buying a condo, for example, is there enough reserve fund in the condo corporation that you're buying? Because it is an investment. It's a lifetime investment when you're buying your first house. And when I started a long time ago, I always tell my clients that when you're buying a first-time house, this house may not be your permanent home. It could be your first starter home, and then you just kind of work your way up, and because it is an investment. Right? You have a potentiality of selling this property down the road. Maybe life changes. If you decide to get married. When I started, I lived in a 500 square feet condo.
Wow. When was that?
It was back in 96,
Okay.
1996, and that's all I could afford. Coming out from school, we trying to be successful and get a good degree and trying to get your first job and save enough money for the down payment in order for you to gain access to home ownership, right? In the old days, you never had the opportunity to buy a house with less than 5% down. You need to put at least 30 or 35% down back in the 70s and 80s, right?
Right.
Oh, wow. Yeah, you know what? I never even thought about that.
Yeah, CMHC came into play, and it really gave Canadians access to putting less money down to be able to afford to get into home ownership as the cost of housing started to increase in the last 10 years, right?
Right. So how important is that, getting your foot in the door as early as possible in the housing market?
I definitely think it's extraordinarily important if you can, because the cost of rent in Toronto is so excruciatingly high that if you are renting, and what's the average rent nowadays for people? Like
I live at home with mom and dad, so I don't know too much, but I would say ballpark like 20.
1,800, 2,000, 2,500.
Yeah, it depends on the area you're talking about and the size you're looking for. But if you think 1-bedroom condo downtown, you're looking at least $2,000.
Minimum $2,000.
Yeah.
Plus maybe you're looking at fees.
Then you pay hydro on top of that. And you pay
Hydro.
internet on top of that. And
Now, back in your day when you said, so did you live on rent prior to buying your first home?
I did. I actually rented for a few years
Okay.
because my job wise, you're starting from the bottom.
Yeah.
And you got a budget, right? And so at the end of the day, back then, rent was about $800 was my first one to $1,200 range.
Wow.
Back then.
Yeah.
And so I really did the math, realizing that getting started in the mortgage business myself, you had to be in the business of experiencing what does a first-time home buyer actually go through, right? And paying someone else's mortgage, hands down, I would be rather pay my own mortgage, right?
Of course.
Because the equity that you make on your house over time is tax-free on your principal home. So it's like you're borrowing the bank's money to make money, and the younger you guys start, not only understanding the process of what we do, but I think it's important to realize that you are going to benefit from the power of compounding interest over time, because that equity, hopefully, even though in the last 20 years we've been kind of going, on a very high trajectory on cost of homes going up, the equity that you're making is tax-free, and you're going to benefit from that. So the sooner you start, the better it is. So that's a great question.
I'm going to go back to something that you said, right? Let's pump the brakes for a second and talk about compounding interest, right? So people see on their mortgage, I'm paying 3.5%. Not bad. What does that actually mean? So now that we have been in the business, we've seen amortization schedules.
Sure.
We see how much money goes into principal and how much money goes into interest. And there's a lot of people that don't even know something like that exists, or they haven't wrapped their mind around to think of what that looks like. So you want to talk a little bit about what you actually mean by the power of compounding interest, because it's such a detrimental thing that if you don't realize it early, you could spend more than you expect just pouring it away into banks' interest,
Right.
or lenders' interest.
I think it's a great question. I think banks are in the business of making money, and so certain banks will compound their interest monthly versus semi-annually. So working with a good mortgage broker will give you the power to choose the right mortgage that fits you based on your budget, based on your needs and whatnot. But a lot of the banks have gone to collateralizing their mortgages, meaning that they can compound their interest monthly. So even though on paper you might be, having the same interest rate on both deals,
right.
The power of compounding interest is detrimental in the sense that if it compounds quicker, it's like having a snowball. You make a snowman, you roll down the snowman, you start with a little ball, you roll down the hill, and it gets bigger. Same thing with interest. So banks make money and not only charging an interest rate, but they compound the interest differently.
Bang on. So we were talking about down payment a little bit earlier. We were talking about
how to save for a down
how
payment?
to save for a down payment. But we were also talking about, I think Jacob brought it up, how early should you get in or something like that.
Mm-hmm.
Let's talk a little bit about
Sure.
insurable business. Let's talk a little bit about, we were talking about 35% down, and then CMHC came in and they implemented some rules where people can buy a home with 5% down only. So let's talk a little bit about that. So for yourself, would you now that you've been in the business for a little while, would you go up and save 20% before you get into the housing market? What are kind of the pros and cons? Maybe we can have an open discussion on that.
That's a really good question. Just so it's clear, the rules are if you have less than a 20% down payment, you have to pay the CMHC insurance premium.
Out of the
just so we're all
yeah.
clear on that.
Yeah.
I've thought about it both ways, and I think that if you're looking to get in earlier, which is kind of what we established is the goal, having 20% down payment is not vital. You can get away with paying the insurance premiums for as long as it takes to be able to have that property work out for you.
So you mean kind of get your foot in the door early doesn't mean that you necessarily have to wait for the 20% down, right? Because by the time you get in, let's say you've got 10% down, it's going to take you another 3 years to save 10% down. If we would have seen, in the previous 25 years, the trend that we've seen, 3 years could be another $50, $60, $70, $80,000 in equity accumulated, which would surpass the amount of time that it takes you to save an additional 10%, right? So getting in early, like you said, the power of compounding interest, the power of building your own equity, sometimes it's a little bit of a trade-off.
Yep.
By having an insured mortgage. So I have the breakdown here with me. If you have 5% down, you will be required to pay 3.6% as a CMHC premium.
Of the net mortgage amount.
Exactly. Mortgage. Of the net mortgage amount.
And it's it works like a staircase. So the less money you put down, the higher the risk for these Canadian Housing Mortgage Insurance to insure the banks for default. Basically a default insurance.
Correct.
Doesn't really do anything for you, but if, to give you the ability to get into access to home ownership earlier, CMHC is willing to insure Canadians depending on the staircase level of 5%, 10%, or 15%. As you start rising in the increasing in down payment, the premiums will drop, right? Because it's less risk, kind of, in a way, right? So that's why clients want to save up to 20% down, because by doing that, you eliminate the cost of that CMHC insurance.
Yep.
And two, you gain access to a longer amortization, which is 30 years.
Bang on. Yeah.
Right? So on cash flow, if you can have access to 20% down payment, then you avoid that CMHC insurance. But if you don't, like you said earlier, Sammy, you can put 5%, 10%, gain access to home ownership, and be able to ride the wave of the rising cost of homes as well.
Right.
So I was crunching some numbers with a client, and she's looking to purchase a $500,000 home, very standard for first-time home buyer, just outside of the GTA. Mm-hmm. And we were having this discussion. She said she has about $100,000 down for a $500,000 purchase. That equals 20% in her mind. Check, check, check. She's ready to go. She's talking to her realtor. She's saying, you know what? Get me a mortgage, or find me a house for $500K.
Yep.
And I said, you know what? Great. But we go back and we peel it back, and then we start talking a little bit. We say, okay, $100,000 is all you have? And she says yes. So then we start breaking down some of the other costs that she's going to need rather than just the down payment, which we'll go down into in very, very much detail. But in her mind, I even asked her something very simple. I said, what, some of the soft costs associated with buying a home. I said, how are you going to furnish your home? She goes, I don't know. Maybe I'll get a credit card. So I said, okay, you got to think about, how much you want to furnish the home. How much is that going to cost? I said, we got to talk about
renovations, painting, right? light little fixtures, curtains.
And these are soft costs. That's not even costs, some of the closing costs that we're talking about.
Yeah.
So,
well, a funny story? When I bought my first condo, I had didn't even think about that. I moved into an empty house. I was like, oh, I need blinds because everybody gets this condo. You can see me, right? So that cost like $1,500 just to put in curtains, which I wasn't budgeting correctly.
Yep.
Right? Or painting, because when you buy a brand new condo, it's flat white, right?
Yeah.
So choosing the right colors and moving expenses. There's always going to be the hard costs of doing a mortgage, right?
Yeah.
Lawyer fees and
disbursements,
fire insurance policy. A lot of people don't realize you need certain costs other than just your initial down payment to close a mortgage transaction.
So let's go back into conventional versus insured, and that way we can just wrap that portion of it up. So conventional mortgage means anything where you have 20% down or more on the actual net mortgage amount. insured mortgage means that it is being insured to, provide a little bit of leeway for the banks to be able to get you into that housing market earlier rather than having 20% down, right? So you can have a minimum of 5% down. If the home is $500,000 or more, you need 10% down from the final purchase price. Now, I do have that ladder or that tier so people can kind of understand exactly how much is CMHC insurance, and then they can make the decision on their own as to whether having CMHC insurance is detrimental or not.
Well, yeah.
Or whether avoiding it and having the 20% down is worth it or not. So if you have 5% down, you would be paying a 3.6% insurance premium on the back of the mortgage from the net mortgage amount. The next ladder is 10%. If you have 10%, you would be paying an additional 2.4% roughly, and you would add that to the back of the mortgage.
Is this regardless of the size of the mortgage?
Correct. 2.4% of the actual net value of the mortgage.
So whether it's under or over 500,000 doesn't make a difference.
If it's over 500,000, I just want to clarify, you need to have 10% down.
Okay,
So
that's
if
good
it's
to know.
even $502,000,
Yeah.
you got to have 10% down, no questions asked.
Got it.
If you have 15% down, you're only paying 1.2%. So going back to my client situation, I said, you know what? Let's not put the full 100,000 down. Let's look at how much 75,000 down. Let's see if you can still qualify. Let's now figure out that, okay, because we're doing an insured mortgage, the maximum amount of years that I can amortize, or the maximum at this very moment that I am allowed to carry this mortgage, is 25 years. If the client put 20% down or more, they can stretch their mortgage out to 30 years. Now, what that does is that would probably result in a couple $100 a month in cash flow. Luckily, the client actually did have the capacity to pay 15% down. She saved about $25,000 for, blinds, curtains, furniture, whatever
Soft
else.
costs.
Soft costs.
Yeah.
And we went from there, and I broke it down to her, and I said, okay, 1.2% of 500,000. What's an extra $5 or $6 grand? Is it that important to you? She said no. She said add it on to the back of the mortgage. She couldn't afford to pay it up front, and that's that. So it's not a very sometimes detrimental thing to have the 20% down, but there are differences. Mm-hmm. And I think having a great mortgage agent, like we were going back to earlier, they should be able to explain these things and say, okay, these are the benefits. This is scenario 1. This is scenario 2 on paper. Pick and choose.
Yep.
I think to that point, I had a lot of clients when I did deals where they're putting, 9% down payment because they had a fixed number for down payment based on purchase price. And I kind of share with them, like, if you put, if you hit from 9% to 10%, you might save your CMHC insurance premium to the next category.
Yep.
So that's another good segue to really look at the big picture, sitting down with your financial planner or mortgage agent or mortgage broker, and basically kind of say, hey, this is my budget, this is what I'm looking to purchase. Do I going to hit the next tier to save some more money?
Sure. Yeah.
Now, Dion, I think you were saying earlier that there is like a 30 or 40 page or something like that. There's like a manual that CMHC might provide, or like a resource guide.
They call it a home buyer's plan, and basically we can put a link underneath at the end of the podcast to share with our viewers what is involved as a first-time home buyer, what's the process. It has a really nice breakdown of what you should be aware of when getting into your first home ownership.
That's good.
Perfect. And so now that we're going back to down payment, there's a couple more things that we should probably have it nailed down. Down payment, right? So there's a couple of complications that could happen with down payment. Down payment is a very, very important part of the mortgage process. So let's talk a little bit about it. First thing, first-time home buyer's plan or home buyer's plan. For, like I said, we established earlier, if you don't own a home or if you're not on title with a home for more than 4 years, you have
4 years or 5 years?
It's 4 years or more.
4 years?
Yeah, 4 years. So the rule for the first-time home buyer's plan pertinent to the retirement savings plan is this, right? When you withdraw from an RSP, you have to pay what's called a withholding tax. What that means is when you contribute to your RSP, you're not paying taxes on that money. When you withdraw, the government wants to collect their taxes. That's what's called a withholding tax. When you withdraw up to $25,000, which you're allowed to do on the home buyer's plan, you can withdraw $25,000 tax-free.
Per person.
Per person.
Yeah. So if you're a couple, then
you could do $50,000 total.
Right.
So $25,000 per person. Now, what does that mean? Why is that privilege there in first-time home buyer's plan? What does that actually mean on paper? When you do a withdrawal for $25,000, you are subject to a 30% withholding tax from the government.
Wow.
So that means $25,000, 30% of that, you're looking at about $7,500
Sure.
right off the top. But as a first-time home buyer, you are allowed to withdraw that money, claim the full value of the $25,000,
Tax-free for
tax-free, and put that towards the down payment of your home, with your responsibility to pay that back. After the first 2 years of actually withdrawing the funds, the bank will put you on a schedule where you need to repay for the next 15 years that $25,000 back.
into the RSP.
Back into the RSPs.
status.
Yeah. You recontribute it back into the RSP.
So I think to our viewers, I think it's good to start young, but when you start working, always try to start saving and buying some RSPs so then you can contribute to this home buyer's plan from the get-go.
Yeah.
So if you're making half decent income, it's kind of nice to maximize your RSP, because when I used to work for a bank before, the banks were nice enough to contribute my RSPs. So that's 100% return right there. Plus, if you invest in something that's safe, you have the power of compounding interest that works for you for the next couple of years until you save your 5 or 10%.
Yeah.
Right, and then be able to exercise that down the road to moving one form of investment to another, which is your home. Right.
Yeah.
So it's a great way
Without
to
paying
do it.
that tax.
Without deferring the
that
tax,
tax.
right? And so you're paying less income tax for the next 2 to 3 years. You're saving. You get to move one investment to another, not pay the tax right away. Yes, you got to repay that thing after 2 years.
After 2 years, and you get 15 years to pay it down.
Right.
Yeah.
So 25 grand over 15 years. Down the road, as your income starts to support it, it's not a very difficult
Big deal.
thing to pay back.
Yeah.
So we spoke a little bit about down payment, first-time home buyers plan. There's some more that we should probably talk about with down payment. Something that we're seeing pretty often now that homes are getting pretty expensive, is gifted money.
Yeah,
Gifted
down.
down payment.
Yep.
So what that could look like is somebody in the, correct me if I'm wrong, I think it's the immediate family, right?
It has to be immediate family.
Yeah.
So usually what happens, a lot of my clients will say, I only have 10% down, but my immediate family, my mom or my dad or my brother, sister,
brother, yeah.
is going to gift me down the extra 10% so I can hit that 20% mark where I'm not paying the CMHC insurance premium and gaining access to a longer amortization to lower my monthly payments, right?
Right.
So that's something that people are doing, gifted down payments. There's a lot of equity being transferred from one generation to another now, especially
Absolutely.
for me.
I don't blame them with
Yeah.
how expensive the houses are
Yeah,
getting.
parents need to jump in to help out.
Or
And-
people that have been in the, sorry, I don't mean to cut you off. The people that have been accumulating their asset for the last 25 years, they would have bought it, back in, let's say, 85, 90, like my parents, at 200,000. Now that property's worth over 1.2. So the people that have done very, very well, they want to be able to support their kids and say, you know what, like, now that I've got the resources, why not take advantage of what we're allowed to do as gift, right?
Mm-hmm.
For sure. And I feel like for a lot of people, that was their plan. Their nest egg is in their home that they've been working
That's
on
it.
for the
Yeah,
last
yeah.
25 years,
Yeah.
and that's what they have to pass on to their kids as well. And just on another note, when you get a gifted part or all of your down payment, there has to be a gift letter accompanying that.
Bang
Is that
on.
correct?
Yeah. So that gift letter, you guys want to talk a little bit about that gift letter?
Sure. Yeah, the gift letter is basically it's a non-repayable gift signed by
Yeah.
your parents, basically.
A non-repayable gift, i.e. loan.
Loan.
You're right? That's
Yeah,
exactly.
well,
that's what the government wants to know. Is it a loan or is it a gift?
It's a gift.
Yeah,
So
yeah,
you don't need to repay them back. It's a genuine gift
Yeah.
from one generation to the other to help my kids out, right?
Yeah. Doesn't
Yeah.
affect your ratios.
Doesn't affect your ratios or anything, but being a first-time home buyer, you should create a mortgage file.
Yeah.
Right? So you have all your important information in this file that you're going to grow with your mortgage broker, your lawyer, your real estate transaction. You have it all in one file, right? Getting the down payment. What does it mean by getting a gift letter? When does the money have to be deposited, right? We need a paper trail because the anti-money laundering laws
For sure.
in Canada, we have to see a paper trail. Is this legitimate money? Where's this money being moved from?
Right.
Oh, it's coming from your dad's account, so then we might need 3 months bank statements to show that the money is coming from your dad's account, moving into your bank account.
Yeah.
Right?
Yeah.
So having that process and being able to verify income and down payment is going to be very important for any first-time home buyers.
Now, documents.
Yes.
You either hate them or you love them, right?
Well, it's doing your due diligence. I mean, the reason why here in Canada we didn't go with the mortgage crisis like in the States is really doing our due diligence and working with our clients and say, we need confirmation of income, confirmation of down payment, and this is what we need to see.
And there's a reason why. It's not that we're doing it just to be, the big bad broker or the big bad banks. It's at the end of the day, these banks, even us, whether you're into private lending, whether you're into alternative aid lending or whatever you want to call it, we're not in the business of providing you a mortgage to take your home.
No.
Everybody wants a seamless process. Everybody wants to make a little bit of money, and they want to make sure that you get what you're looking for at the end of the day as well. We spoke a little bit about the mortgage file. Why would you need a mortgage file, right? Like I know, Jacob, so for example, you're doing a new build, right?
Mm-hmm.
New build could take 2-3 years sometimes.
Yep.
Even 4 years.
Yeah, so even 4 years. And a straight up purchase or something that's a resale could be as quick as 1 month.
1 month to 3 months.
It could be whatever, right? So having that mortgage file allows you to keep on pack exactly what do I need for down payment, and this is something that your mortgage agent should be doing with you prior to you looking for a home.
Yep.
Getting documents for income is very important. I mean, make or break a deal right now because the new mortgage rules are being in place. You need to have the documentations ready. And you want to be able to jump on a deal. If you're putting an offer with a real estate agent, you want to make sure all your ducks are aligned.
Of course. Yeah.
Like if I'm salaried, like a lot of people say, oh, I make $80,000, and then we go to a broker or a bank and you get everything approved. And then when you get to the income documents down the road after you waive conditional financing, we realize you only make $60,000 because that's what
the underwriting is done completely differently, right?
Yeah. Completely different. And that's what we got to spend a little bit more time as mortgage broker professionals to get to know your clients. How are you compensated?
So pre-approval.
Yeah, I was just going to bring that up.
So let's talk about pre-approval. Let's do it.
Okay.
First, second, third, fourth, fifth. What do you suggest when you're doing a pre-approval? Would you say that's probably like one of the first things that you should be doing?
Definitely.
Yeah, absolutely. It helps you establish your budget. You need to know what your budget is before you start looking, and like Dion just said, no realtor is going to want to make any firm decisions with you if you don't have a firm budget and a pre-approval that you can fall back on.
Yeah, and you know what I've seen recently, although technology has been great, mortgage agents or specialists or whoever, not to knock anybody, they'll send the client a paper application. The client will fill out their application based on what they think is true.
Yep.
Whether it's a mistake or whatever they think is true, they send it back. They plug in the numbers and they say, you know what, Joey,
you're pre-approved for
$500,000.
Mm-hmm.
When you actually go in and you collect these pre-approval documents, you look at the way that things have been underwritten, whether it's a rental property. You look at having commission income. How long has this person been in commission? So I think the pre-approval needs to be done like pretty much face to face.
Yep.
I really do. I mean, technology has changed the business that we're in, and I think that this is still a people business, like you said, Sammy.
Yeah.
And working with a good broker that actually listens to your needs and be able to ask the right hard questions, like how are you compensated? What's your base salary? Is there a bonus component? Do you get commissions? I have clients that get car expense. Is this guaranteed? Can you put this in the job letter? Because all that can add up to your total income, and the more income that we have that is verifiable, that is going to be the key to either getting you into a $1 million house or a $700,000 condo.
Or right? Sometimes that could be the key for you getting sued or not sued if you're going firm on a purchase.
Yeah, you might lose your deposit. I mean, if you waive the conditional financing and you're thinking that you make $80,000, but technically you make $60,000, the stuff are just all riders, and you don't have a 2-year average.
Yep.
Then that deal might go south and you might get sued, plus you lose your deposit, which is very important to really be open, talk to your advisor, talk to your agent and say, this is how I get compensated. I've only been here. I just passed probation. I have a commission component, but I've only been doing this for 1 year and I'm putting less than 20% down.
So something that I've started asking, pretty open-ended question. I ask all my clients this. What do I need to know that I can't see on paper? And, things start to spew out. I got child support payments. I get alimony payments.
Tons.
The $80,000 that I wrote in income is actually from mostly child support. Right. Or the $80,000 in income that I have is from child tax benefits or whatever, right? And there's so many things in here based on a particular bank's underwriting guidelines that $80,000 is maybe only $64,000. Or what you thought was $64,000, maybe it's $75,000. I just had a deal not too long ago, and and we were just talking about it's super creepy how you like pinned it right on the head. A client was looking to get pre-approved, and he couldn't get the amount that he was looking for. And I said, okay, well, on your bureau you have a car. Tell me about your car. She said, you know what, my company pays for it. I said, so that changes everything. Go back, get a job letter, tell us that your company pays for it, show us the proof on the paycheck or the pay stub or whatever,
Yep.
and that changes. That makes a $600 lease. That bumps her ratios in line and says,
Of
you know
course.
what, you're not
You wipe it
qualifying.
out.
Yeah.
You're not qualifying for $450,000. Now you qualify for $485,000,
Yeah.
Right.
and you can get into that $400 and whatever $1,000 home that you need.
Yeah.
So, yeah, documents, right? And there is a difference between, and we should probably do a segment on this completely differently
Completely
next
different.
time.
I
on
think
documents.
we can really go on a lot talking about the first time home buyer segment.
Yeah.
But I think that a lot of the clients don't realize that going back with the down payment, if your mortgage is CMHC insured or less than 20% down payment, in our day and age, you actually get a better interest rate. Even the old ways of thinking, the more money you put down, it should be less risk.
Yeah.
Nowadays, for the banks, they're saying, well, you know what? If you put less money down, my mortgage is going to be insured by the CMHC insured. That even if you default it, I get my money back, and that's why I can give you a much lower interest rate on a less money down versus some guy who's putting 20% down.
And he's doing,
Right.
I think the rule should be a little bit inverted, but again, right, the insurance company's got to make some money, and that's how they've done it through many, many years, is all through volume. They do it through, I'm going to take in all these mortgages, you can pay a little bit less down, we're going to give you a better deal for doing that too. But I think that, equity mortgages, or people who've got 30-40% down, they should have their own incentive down the road. I think that's what would be important there. Should we go back a little bit with costs for closing a
Whatever you want,
mortgage?
yeah.
We've got closing costs, legal fees,
What is the umbrella of closing costs? I mean, closing costs is obviously lawyer fees, right? Like you said, Sammy.
Yeah.
There's fire insurance. You need a fire insurance policy in order for you to close a mortgage transaction.
Yeah.
Moving expenses.
What about the realtor's commission?
Realtor commissions.
Realtor
Yeah.
commissions.
Bang on. That could be almost
right.
2.5 whatever percent.
Yeah.
Title insurance. You want to talk a little bit about title insurance?
Yeah,
So
I'm not
title
an
insurance-
expert on it, but
Yeah.
I mean, usually what happens is you're a real estate lawyer. If you're working with a good real estate lawyer, 99% of the time they're going to be suggesting you to get that title insurance policy to cover a numerous blanket amount of different various items. From title fraud to title defects and whatnot. Right?
Survey issues or whatever.
Survey issues, property lines, or your fence is off by an inch down the road and 4 inches near the 120-foot lot. Then if something did happen, you being the new homeowner, you don't want to be responsible to tearing down that fence and repaying to rebuild that fence.
Exactly. You put all $100,000 of your money into that home, towards down payment, towards furnishing. You don't have money to get sued after, right? So that's why that title insurance, it's a one-time pop. It could be anywhere from a few $100 to $1,000. Like you said earlier, get your real estate lawyer to tell you that, but it's definitely well worth the cost. And I'm pretty sure, I don't think I've ever seen a deal done without title insurance.
Fire insurance, content insurance, and title insurance is definitely a must.
Are content insurance and fire insurance the same thing?
Content insurance, well, there's different types of insurance, right?
Yeah.
The content insurance is to insure the inside of the house. So if the house was, burnt down to the ground, the lender can get access to this insurance company to pay for the renovations. Right?
Gotcha.
Appraisal. Let's talk about appraisal for a second, right? Whether you're doing a purchase or you're going to do a refinance or whatever the case is. I know we're sticking with first-time home buyers, but appraisals, they're not super duper expensive. What's the purpose of an appraisal? Or what's the difference? Actually, you know what? What's the difference between an inspection, a home inspection, versus a home appraisal, right? What are some of the differences that you're going to get, and why would you do both?
Major difference.
Yeah.
There's major difference.
Major difference.
When you put 20% down or more, the banks will require a full appraisal where they actually go into the house, take measurements, take pictures, and they basically compare 3 most recent sale that are similar size and shape home on that street. So they want to compare apples to apples. So if you're buying a detached house, they want to make sure that you're comparing a detached bungalow, 1,200 square feet, same size bedrooms, bathrooms, and whatnot.
And I think it's like within 60 or 90 days or something like that.
30, 60, 90 days. The more recent, the better. And that's why appraisals are only good for that period only. But it's just really to help the banks to determine what is the value that you are paying for it. Are you overpaying for it? Especially in the last couple of years when the real estate market was really hot. People were overbidding on homes. There's 20 offers. Well, banks are concerned that is that house truly worth what it's worth?
What is the cost versus what is the value?
Yeah.
You might be paying $1,000 for your asset, but maybe your asset's only worth $750. Right.
So that appraisal will tell the banks and the lender that you are in that ballpark. Now, if it's CMHC insured, it's going to be done through their huge database based on postal codes. So the valuations can vary, but the number of comparisons are way more.
Okay,
So on the laws of averages, CMHC or GE or Canada Guarantee will have their own database where they say on average 10,000 homes sold in this postal code is the X. So the values will be Y, right? Now, Sam, you were asking about what's the difference between appraisals and home inspection. Home inspection is something that I highly recommend, and then its cost of doing business and its cost of part of your closing costs is when you're spending $500,000 to over $1 million to buy a home, you want to make sure that the asset that you're buying is in good condition. A lot of homes that are put on sale nowadays, they could be just fixed up. It could be a water leak or water damage. The home inspector that you do pay will determine, A, is the house in good order? What are the structures of the house? Usually they have an engineering background. They'll come in with an x-ray machine going through the walls to see if there's any, what's the pillars like? Is there termites? What's the air quality of the home? What's the ventilation? What's the economic life of the roof? Do you need a roof replacement? How are the windows?
So I think it kind of goes back to you can't just judge a book by its cover, right?
No.
And you go in there, and when you're doing that home inspection, you're going in there with a little bit more of a fine-tooth comb to say, okay, what am I working with? Is this just a patch-up?
Yeah.
Or is this an actual home that is beautiful? Or is it somebody that's gone in, patched up some drywall? There's no insulation in the back. There's mold. There's whatever, and something that you can't see through the naked eye.
Yeah.
Right.
And then also it could be a project and a half. You buying this house, all of a sudden, and I've had clients buy a house so that was quickly fixed and resell, and they bought on looks only, and not realizing the foundation shifting. Oh my God! Now the house is going to collapse because the foundation shifting. Well, if I would have known with the home inspector that the foundation is very weak, I would have bought this house, right? Yeah. So spending that extra money, going with a home inspector to figure out if the house is good I highly recommend that. Appraisal is really more for the lender side to make sure that A, you're not overpaying for the home, and make sure that you're on par.
Yeah. Now there's obviously going to be a little bit of an exception where there's something additional that's a precaution that your lawyer should probably be taking. But as a good mortgage broker, you want to make sure you get it about 10 days, 12 days, 15 days in advance. That would be, and you just taught me this word, so I'm going to try it here. Stoppable certificate? Status certificate?
Status or stoppable certificate?
Stoppable, there you go.
Yeah, a lot of people don't realize when you're buying, in Toronto, we're becoming more of a condo type of environment like Hong Kong or Shanghai, where, the density of homes are increasing, like Vancouver, for example, right?
Yeah, a lot of high rise.
And so a lot of people, when you buy a condo, you pay condo fees, right? Better locations, you pay higher condo fees, more amendments, like if there's a nice gym, there's a swimming pool, the more things you have in the condo, the more your condo fees will go up. The importance of getting the stoppable certificate or the status certificate is to see if that condo is in good standing. You want to make sure that there's enough reserve funds in that condo corporation that you're buying into. There are cases where the condo corp is being sued or suing something or someone, and you want to make sure that all the condo fees that are being collected on a monthly basis, there's enough on the reserve for any bad emergencies, flooding or the roof caves in, or building damage, or I've been in condos before where there was flooding and they didn't have enough money to pay for this, so. Getting that status certificate will tell the lawyer and you as a buyer that there's enough money in the reserve fund. There's no funny business on the side.
And you know what? I think as a buyer, you don't need to be an expert on status certificate or estoppel certificates. The fact that
Let
you
your
know
lawyer do
what
it.
one is, yeah, let your lawyer do it. But be open enough to ask and say, you know what? I'm gonna live in this condo. This is gonna be my condo. I want to know everything. Should I be concerned with the status certificate? Can you explain it to me? Right? And I think that's what's gonna keep you the most informed, and I think that's what's gonna put you ultimately in like the best possible position to buy that home and be stress free with it,
Right.
as a shared amenity.
Good.
So I got a few more topics that I want to talk about that we hear pretty often when we're going in and doing our credit interview, or we're doing our interviews with our client.
Yep.
3 pretty popular questions that I get is, all right, Jacob, I'm coming to you. You're not a bank. Why do I pick you? What's kind of the difference between a broker or a bank? Or, brokers are only for people who have awful credit, or brokers are only for people who, they don't qualify at the bank. So
Sure.
what really is a broker able to do, and kind of what are the differences between brokers and banks without knocking the banks?
Sure. Yeah, absolutely. When you go to a bank, you are qualifying for a single product, right?
Okay.
The bank offers one product, and they have a specific set of guidelines through which they approve any applicant.
Yeah.
The advantage of working with a broker is that a broker has access to different lenders other than banks that may have different sets of guidelines that conform better to your personal financial situation, whether they're a little more lenient on credit or they're a little more lenient on your liabilities or whatever it is. The broker will help you find a lender that their approval process caters better to the client's financial position.
Yeah. You know what? I actually just had a client, and I'm going through the process right now. We submitted a deal into the bank, and this gentleman is buying his first residential home. He's got a rental property. Now, from that rental property, in his mind, he's making about $1,000 a month in cash flow. When the banks underwrite it, they have what's called, for example, a rental offset. So although it looks like that this guy's getting $1,000 in rental income, the way that the banks underwrite it, or some of the bank programs, is that we can, you know what? I know you're getting $1,000 a month, and it's on your T1, and we know that it's also on your rental agreement, but we're only going to put down 50% of that. Some of the other banks, and this is something that I just was researching a little while ago, there's some banks that will allow you to say, okay, you know what? We're not going to give you 100% of your rental income to use towards your application income. We're going to use 80%. So what does that mean?
Or 50%.
Or 50%
The
or
banks
80%.
usually use 50% of the
Banks
rents.
use 50, but there's some that will use 80, and that's why it's great
Yeah.
to use the broker.
Right.
Well,
Right?
the broker, the broker definitely offers you a lot more choice to choose,
Yeah.
right? And when you go into a bank, you're working with that one lender, like Jacob said, but working with a good, knowledgeable broker, you have access to 300 different products, 60 different banks and different lenders with
Right.
different rules. Right?
So I have bad credit. Is that the only reason I'm coming to Jacob as a broker?
No.
No.
Bang
On. And that's one of the biggest stigmas that I've heard, or that's one of the biggest myths that I've heard is, you know what, I can't go to a bank because the broker's going to charge me every single time.
Right.
Or the broker is only going to be good for people that have bad credit. If you don't have bad credit, go to a bank. That's what I've heard, and I feel like that's the biggest myth that I've ever heard. And a lot of people are losing out or missing out on access to great resources, great monoline lenders, great, Alt A or B mortgages or alternative mortgages or private or equity mortgages as well.
Yeah, I think
Right.
I think you said it well, in the sense that we're in the business to make sure that the clients get the best deal, right?
Bang on.
We shop the market. If you're not happy with our service, we don't get paid. So our interest is your best interest.
Yeah.
Exactly.
Right. So we want to
Yeah.
make sure that we listen to your needs. What are your risks and tolerances? What's your time frame? What's your goals and objectives? We match the best rates with the best products based on the availability that we have access to.
Bang on.
Yeah.
And I guess the end of it is we have access to sometimes more tools and resources
Mhm.
than your typical bank, mortgage agent, or rep would have.
Yeah.
Yeah, we do.
Something else that I hear often too is, especially now that there's been a big shift in prime throughout 2017 and 18. Do I pick a fixed mortgage? Do I pick a variable mortgage? And the answer is different every single time.
Completely different.
Why?
Why? I think traditionally most people will go with a 5-year fix, but a lot of people don't realize there's a 1-year term, 2-year term, 3-year term, all
Right.
up to 10-year, even 15-year terms, right? And the banks are always going to be in the business of making money, and so the longer the term that you have, I look at it as, do you believe in buying insurance to guarantee that specific rate for that duration, right? So the longer the term, the higher the rates. So you're buying insurance premium to have a rate guarantee.
Okay.
Going with the variable rate, it does fluctuate because it's based on Canada Prime rate.
Right.
Yeah.
And Canada Prime is reviewed various times throughout the year. That could change 6, 7, 8 times a year.
Yeah.
Right?
Yeah.
It may or may not change, but it will be reviewed. Right? So there's less insurance premium on something like that, but there is inherently a potential
More
risk.
risk. Yeah.
Because like recently and for the last 10, 15 years, Prime didn't go up. If anything, it went down.
Yeah.
Right?
Yeah.
But recently we had like 4 or 5, quarter point increases.
Yeah.
And then the market, everybody's like, oh, we're panicking. We got to lock in rates. But at the end of the day, it comes down to how old are you? What's your life cycle? How much money are you putting down payment? Are you in a variable income?
What's your amortization at now?
Yeah.
That
Are
makes
you-
a big difference.
Exactly.
Right?
What's your
Are you
cash
at the
flow?
cusp of 25 years or 30 years? Maybe you should fix it in. Right? So there's some banks that work with your variable or your floating rate, as you'll hear. Floating rate or variable rate goes up. That doesn't always mean that your payment goes up. Some banks will just extend your amortization. They'll say, you know what? Previously you owed us 25 years worth of mortgage for these payments. Now that you have not increased your mortgage amount
Yeah.
because Prime has increased,
Yeah.
that 25-year mortgage is now 28 years.
Yeah.
We just tacked on 3 years to your mortgage.
You don't want to get into negative amortization either, but a lot of the clients, when I used to do a variable, I would say, you know what, we qualify you based on the qualification rate.
Yeah, yeah.
That's your payment would be this. Are you comfortable making those payments? If that's the case, then set your payment as like that. And then the difference that you do pay, you're paying 100% pure principal from day one.
Yeah.
Right?
And maybe we should do it.
So if rates go up,
Yeah.
it's okay because you're paying more right up front, right?
Bang on.
So that's something that's a little bit better than just going with the flow, and then all of a sudden you're getting into negative amortization when interest rate starts to rise, right? Which it is right now, right? But like I said, there is going to be a rate difference between fixed and variable. Some can take a little bit more risk. Some can want more stability, and to pick between the two, it really comes down to: do you want your payments to be fixed? Or maybe your life plans are going to change.
Yeah, or you're going to play the gamble a little bit, or
Yeah.
you know what, your amortization, you've only got 10 years left on your mortgage.
Right.
So you're okay to ride out the wave
Yeah.
of variable. People that, get the worst end of it, or even with any investment, is that they'll change their risk tolerance. They're going to change, you know what, today I like variable, but next year I'm going to like fixed, and then I'm going to go back to variable. Those are the people that end up being affected the most and kind of get, shafted at the end of it, and they realize that their 25-year mortgage that they could have paid down in 20 years has now gone up to 30 because I keep changing my mind as to whether I want fixed, variable, or
Right.
whatever the case is.
Yeah.
But I think also, right, for the fixed and variable, your life goals changes. Like I had guys who were single, they're buying their first condo, and all of a sudden, 2 years down the road, they got a 5-year fix, and then all of a sudden, I'm getting married. I found a partner. I need to sell. Well, breaking a fixed rate mortgage, you're going to pay way more in penalties than you do, especially in the first 2-3 years, right? Versus a variable, depending on the type of variable rate mortgage you get, you can pay 3 months interest or up to 3%, depending on if it's a low rate type of variable.
And that information is in your disclosure documents, and it's put as a very, very friendly term: prepayment charge. That just means you're going to pay a penalty if you break it.
Yeah.
And I think there's a stat out there that says within the first 5 years that anybody gets into a mortgage or purchases a home, or let's just say they get into a mortgage, within the first 5 years, most people, and I think it's around 70% or whatever, will break their mortgage because of some life change. Whether it's they get married, whether it's they separate, whether it's they lose their job, whether they move, or whatever the case is. So the first 5 years, sometimes like you said, just going straight off the cuff and saying, my mom and dad told me to get a 5-year fixed, not actually understanding your life scenario, that might not be the best thing, because within the first 5 years, if 70% of first-time mortgage holders are breaking their mortgage, that means you're paying a penalty.
Yeah. I mean, I had a case where I had a guy that we had a time where the 10-year fixed rate was really good, right?
10-year fixed
10-year
rate.
fixed
Wow.
rate. It was like 3.89 for a 10-year fixed rate.
That's really good. Wow.
It was a very good rate. But at the end of the day, I asked some really probing questions like, how's your job stability like? How's your relationship like? Because if things do change and you're paying out a 10-year mortgage in the second-year term, that penalty is astronomical
For sure.
versus paying 3 months interest and you're out.
Yeah.
Right.
I mean, asking them what has changed in the last 10 years that you think might change in the next 10 years. Holding a 10-year rate just because it's a great rate doesn't mean that your life cannot change, right?
Yeah.
And I think that's the important part of when we're doing a discovery or credit interview. We're talking not just about the financial aspect, but let's talk about your personal goals. Let's talk about your life goals. Let's talk about what could change in your family scenario. What's the most important things to you? And this takes me back to my beginner days, but it's something that you should be exercising as a mortgage agent, whether you're beginning, whether you're 30 years down the road. Personal or financial discovery are equally as important, and they need to be done thoroughly as that KYC or know your client, whether it's an investment, whether it's a mortgage, or any aspect of your financial life. Speaking of which, I think we're going to go down to the final topic.
Which is what?
Creditor or life insurance.
Oof. That's a hot topic.
Creditor or life insurance, right? People think that, you know what, the bank just tacked on this $200 insurance fee. I'm not going to pay that. What's that for?
Yeah, that's a good topic, Sammy. And being in the mortgage business for over 20 years, I've seen a lot of scenarios where I've had clients that unfortunately did pass away on me during that duration, and going through the understanding of insurance and the importance of protecting your asset is very important. And that's a topic that most brokers kind of maybe shun away from,
wishy-wash over,
or just kind of like, don't worry, just waive it. Well, you know what? I truly believe in the insurance as long as you answer the health questionnaires truthfully, of course. But the premiums that you pay, especially when you're a young guy. I wish I did my life insurance when I was your age, because I would have been paying $25 a month versus now I'm paying $300 a month.
Right.
Wow.
Because now I have a need. So when I'm 25, 26, you're buying very less expensive package of insurance to protect you for the next 25 years, 30-year term, right? So by the time you're at 30 years to your life, you're going to be in the highest debt load. You're probably going to be married or with kids, and your financial responsibility during that time frame is going to be astronomically huge.
Yeah.
If anything happens to you in that moment, you have a lot of responsibility.
Yeah.
But after 20, 30 years, your kids might be old enough to take care of themselves, so you don't need insurance afterwards.
Yeah.
Maybe you would have paid down your mortgage to the point that you don't have a mortgage anymore over the next 20, 30 years if you do a term 20 or term 30 or whatever.
Yeah, I would just match the amortization on the mortgage. If you get a 30-year mortgage, you get a 30-year term. If you get a 25, get a 25, whatever.
Yeah.
But at the end of the day, what I look at it is that $25 a month times the next 5 years, what is that valuation? Versus the benefit that you're getting, which is tax-free. It's tax-free money. Right? There's nothing certain about life is either taxes or death.
Yeah.
We
Two
don't know,
things you got to do.
Yeah, you don't know when you're going to be born, and you don't know when you're going to die. But within that period of time frame,
you're paying taxes.
you're going to pay taxes every day, right? Or you got to make sure that you live long enough to have a full life, right? And I've had cases where my clients did pass away, and they called me and said, Dion, did we buy life insurance? I'm like, yes, we did, right? And your husband did pay for the insurance, so you're protected, right?
Wow.
So
And
being on the receiving end on the other phone, when you actually go through and say, wow, I actually sold this life insurance policy, not because you're selling, that you actually changed this person's life, because now this family with kids don't have to worry about a mortgage because you spent that extra 5 minutes explaining the ins and outs of having that protection. Right? It's very powerful. And at the end of the day, you're going to die. Unfortunately. We just don't know when.
Yeah, exactly.
Right?
And that client that you're telling us about, so was the mortgage, how long have they had that mortgage before the husband or the partner passed away?
Yeah, they just had like before funding, actually. So there is a policy when you actually sign, and then as long as there's a box that you check that I'll accept the payments right up front from date once you sign it based on the date of inception, that will be paid.
Can you imagine being that family? You're excited, you just bought a home. 3 months, 4 months, you start packing up the home. You start to get the kids out of school. You start transitioning. You start looking for a new job. You start doing whatever. You shift your entire life. And right before closing, someone passes away.
Heart attack.
And you sit there and you think to yourself, if I did not get that life insurance.
Sign it and cancel it later. If you
really have to.
If you have to, just sign it and then talk to your insurance advisor to get your own term life insurance, whatever. But the younger you are, the better it is, and that sense of protection even at $22. Put it on your credit card with air miles. You get air miles every month. But you're buying future money tax-free, period.
Yeah.
Right? And the younger you start, the less expensive it is.
Or you know what I always hear people say, and I'll ask them, what are your priorities? What is the most important things to you? And they say my health, my family. And I'm sitting there thinking, you're skimming dollar for dollar, or you're kind of washing over creditor insurance or life insurance or whatever the case is, but yet you're saying family's the most important thing. What if something were to happen to you? What if you guys can't sell that house? What if the cost of rent goes up so much and your mortgage is so little? What is your family gonna do? Are they gonna have enough money to put food on the table? Month in, month out.
It's maintaining lifestyle.
That's exactly it,
And
right?
and that
Quality of
insurance-
life is super duper important when you're talking about life insurance. Sure, I could sell the house, and sure, a single mother with raising 2 kids now can work 60, 70 hours a week. But is that the quality of life that you want to live? Or is it worth it to get that $30 or $40 or whatever term or life insurance policy you choose early on? Is it worth it? I think so, if you're saying family's one of the number one priorities.
Absolutely.
And a lot of people don't realize final expenses. Like when someone passes away, you got to, if you have a funeral, how much does that cost? How much is a casket? How much is cremation?
Yeah.
Right?
You gotta
my
travel.
God, I didn't do my income taxes for 4 years. Well, CRA is after you for $100,000 that you didn't do.
Yeah.
Now your family's responsible
Or
for it.
your credit cards, your lines of credit debts. All that adds up to money. So you might have life insurance through work, and that'll cover, whatever.
A small portion or whatever.
This will cover the mortgage, and then the rest is gravy. And that's how I look at it, right? So as long as you answer the health questionnaire truthfully, if you even have a part-time smoker and you say you never smoked, just answer it truthfully and be honest, and the policy will pay itself.
Because at the end of it, right, and I don't mean this in any particular way, you're gone. You're not the one that has to deal with your repercussions. Your family, your loved ones, your immediate household members are the ones that have to sit there and sometimes suffer the consequences of your negligence or whatever the case. And it's a pretty deep.
It's not always a negligence. I would say it's more oversight, right?
Yeah,
Where
yeah.
people say, I don't want to pay something I don't see, right? Mm-hmm. I get that, right? When I was younger, I was like exactly the same thing. I was like, well, I don't want to pay an extra $30 for what, right?
Yeah, I mean, at the end of the day, call it what you will, but it's your family that's affected. Somebody's got to go through the motions.
Someone has to clean up.
Someone's got to clean up.
And I'd rather have the insurance money to help clean that up and put less stress on your family.
Absolutely.
And have your kids focus on school or whatever they need to do in their lifestyle, and they're taken care of until they're 18, until they're old enough to take care of themselves.
Yeah. All right. Thanks for tuning in. I think we had a pretty good discussion. We had so many different aspects that we covered a first-time homebuyer, and I think that's what we were saying earlier. We could go on for 20 more hours about these subtopics. I want to say thank you to Jacob for joining us.
My pleasure.
Thank you.
Uncle D, the man of wisdom. We got a lot of more stuff coming out. If you found this informative, like, click, comment, subscribe. Do what you got to do. We'll see you guys again back in the boiler room. Remember, it does not get any more exciting when you talk about mortgages than it does here.